Okay, let us continue our discussion, sir. We have started the consolidation procedure. Consolidation of balance sheet we have started. In consolidation of balance sheet, there are, I told you, 9 steps involved. One is date of acquisition. First, we need to determine the date of acquisition. Then, shareholding pattern we need to find out on the date of consolidation. And I told you the most important step is analysis of subsidiary company reserves and surplus. After that, apportionment of profits. After that, minority interest. Next, cost of control step. 7th, intercompany transactions. 8th, reserves for consolidated balance sheet. And finally, we need to prepare the consolidated balance sheet. And yesterday, through examples, I have introduced the concept of cost of control and also minority interest. So, in the consolidation procedure, we have understood the basic steps. Now, what I am going to do is, I am going to discuss each and every step in detail, especially the analysis of subsidiary company reserves and surplus, which is the most important step. Analysis, apportionment. Once you've done the analysis properly, then apportionment, minority interest, cost of control, so reserves for consolidated balance sheet, these steps will be very easy. Okay, so let us start. So whenever you want to do the consolidation, sir, whenever you want to do the consolidation of subsidiary company, always the first step is determine the date of acquisition. Determine the date of acquisition. On which date parent company has acquired the control of subsidiary company. Sir, why we need to determine the date of acquisition? Because in step number 3, when you want to do the analysis of subsidiary company profits, so this date of acquisition is very, very important. So there is a link between step number 1 and step number 3. Step number 1 and step number 3. As I told you, each step is logical and interlinked with another step. So the first step is identify the date of acquisition. Identify the acquisition date of the parent in the subsidiary company. And the main object of determination of date of acquisition is this helps distinguish pre and post acquisition profits for accurate profit analysis. Sir, at the time of consolidation, we need to analyze the subsidiary company reserves and surplus into 2 categories: pre acquisition, post acquisition. Now, to analyze this, we require date of acquisition. Whatever the profits are there in the subsidiary till the date of acquisition, they are called pre-acquisition profits. Okay. After acquisition of subsidiary, whatever the profits generated by the subsidiary, they are called post-acquisition profits. Why this analysis is necessary, I will explain in step number 3. So this is the first step. Second step, sir, ascertain the shareholding pattern. Ascertain the shareholding pattern. That is, on the date of consolidation in the subsidiary company, who is having how much share? Parent company is having how much share? Minority interest, other shareholders is having how much share, we need to determine. So step number 2 is ascertain the shareholding pattern. Establish the subsidiary shareholding as of the consolidated balance sheet. Always it is important to understand, if you want to determine the shareholding pattern, you need to determine the shareholding pattern on the date of consolidation. On the date of consolidation. Suppose you are preparing consolidated financial statements at the end of 31st March 2025. On that date, in the subsidiary company, how much percentage of shareholding held by parent company, how much held by minority interest? Sir, why this step is important? Why we need to calculate the shareholding pattern? Step number 4. Step number 2 is linked with, sir, step number 4, sir. Step number 4. In step number 4, what you are going to do is, the subsidiary company profits which you analyzed into pre and post, they will be apportioned between the subsidiary company shareholders. Who are the subsidiary company shareholders? Parent company, minority interest. So the subsidiary company reserves and surplus will be apportioned between the parent company and minority interest in the ratio of their percentage of holding. That's why in step number 2, we will determine the shareholding pattern. Okay. So see this, parent company, number of shares, percentage of holding. Minority interest, number of shares, percentage of holding, total. Okay. And this pattern is essential for apportioning the subsidiary profits. So tell me, can you help me? Whenever you want to do the consolidation of subsidiary company, when you want to prepare the consolidated balance sheet, so what is the first step? Date of acquisition. Always first in the problem, see what is the date of acquisition. Why date of acquisition is necessary? Because to apportion, analyze the profits of subsidiary, this date of acquisition is important. Okay. What is step number 2? Determine the shareholding pattern, and the shareholding pattern is decided on the date of consolidation. And in the subsidiary company, who is having how much percentage of shares? This is step number 2. And the most important step is analysis of subsidiary reserves and surplus. Listen to me carefully. Analysis of subsidiary company reserves and surplus. Analysis of subsidiary company reserves and surplus. Sir, whenever you want to do the consolidated balance sheet, in the subsidiary company balance sheet, what are all the reserves held by subsidiary company? You take each reserve and try to divide that reserve into 2 categories: pre-acquisition, post-acquisition. For example, in the subsidiary company, general reserve is there. This general reserve balance is on 31st March 2025. Suppose 12 lakhs given. This is the closing balance. This balance you need to divide into pre-post. You need to divide into pre-post. Why subsidiary company profits will be analyzed like this? Why they need to be divided into pre-post? Because as a parent company, I acquired subsidiary on a particular day. On that day, already subsidiary company, whatever reserves are there, actually those reserves, I don't have any investment in the subsidiary till that point of time. Just I am acquiring the subsidiary company. By the time I am acquiring the subsidiary company, already in the subsidiary company there are some reserves and surplus. And imagine, sir, suppose you purchased shares of a company. After you purchase shares of a particular company, that company declared a dividend on those shares. And that dividend is basically your income. You will credit to P&L account. Suppose, imagine you purchased the shares of a company. In the year 2025, you purchased shares of a company. But relating to last year, the company given a dividend to you. Even though you don't have investment in the last year, but before declaration of dividend for the last year, you purchased shares of company and you will get dividend. And what is the nature of the dividend to you? Capital profit. See, if I invest in any securities, after my investment, if my investment has given any income, that is my revenue income, revenue profit. Suppose if I receive any income for the period where I don't have any investment, basically that is capital in nature, capital profit in nature. Similarly, in the subsidiary company, at the time of consolidation, whatever reserves and surplus are there, those reserves and surplus I need to divide into 2 categories, pre-post. Pre means at the time I am acquiring the subsidiary company, what are the profits which are already there in the subsidiary? Actually, I don't have any investment till that time. So whatever the profits are there in the subsidiary company, parent company point of view, these are capital profits. All pre-acquisition profits are capital profits. After I made the investment, whatever the profits earned by the subsidiary, those are called post-acquisition profits. These are my revenue profits. So when you are doing the consolidation of subsidiary, one of the most important thing you need to do is take each reserve of subsidiary company and divide that reserve into two categories, pre, post. How much balance of this reserve is there in the subsidiary by the time I am acquiring the subsidiary? All those are my capital profits. And once I acquire the subsidiary, whatever the profits, whatever the reserves earned, increased, those are post acquisition profits. So pre, post. Because AS 21 says you need to divide the reserves into two categories, pre, post. All pre-acquisition profits are capital in nature. All post-acquisition profits, revenue in nature. Accordingly, we will need to do the accounting treatment. Accordingly, we will do the accounting treatment. Okay. So, like this, we need to analyze the subsidiary company profits into pre, post. See this, sir. What they are telling. Analyze reserves and surplus of subsidiary company on the date of consolidation into pre and post acquisition profits with necessary adjustments. Now, sir, okay, you said we need to divide each reserve of subsidiary company into two categories, pre, post. So, on what basis you will allocate this? Time basis. Always which basis, sir? Time basis we will follow. Time basis. For example, 12 lakhs. You acquired subsidiary on 1/4/2024. Date of consolidation is 31st March 25. So at the end, general reserve is 12 lakhs. And the opening balance is suppose 5 lakhs. That means 5 lakhs is which profits? Pre-acquisition profits. Already this 5 lakhs is there in the subsidiary company at the time of acquiring the subsidiary. So subsidiary point of view, this 5 lakhs is what? Capital profit, pre-acquisition profit. That means what will be the post-acquisition profits? Remaining balance, 12 minus 5, 7 lakhs is the post-acquisition profits. Post-acquisition profits. So suppose for example, parent company acquired the subsidiary exactly in the middle of the year. Then what we need to do? This 7 lakhs will be divided into two parts. First 6 months, next 6 months. Then first 6 months, 3.5 lakhs will be pre. Next 3.5 lakhs will be post. There, understand. Till the time you are acquiring the subsidiary company, whatever the profits are there in the subsidiary, they are pre. Once you acquire the subsidiary, whatever the profits earned increases, reserves, they are called post. So at the time of consolidation, sir, what we need to do is every reserve of subsidiary company will be divided into pre, post. Pre, post. Why we need to do that? Tell me the logic. Because the character of the profit is deciding the fate of accounting treatment. If I invest in shares, after investment in shares, I receive dividend. Generally, that is revenue profit. But if I receive dividend for the period where I don't have investment, last year I don't have any investment. This year only I purchased shares of the company. But this year, last year dividend was declared. So I received dividend. So my point of view, that dividend is what nature? Capital nature. Accounting standard 13, which says, if you receive any dividend from pre-acquisition profit, that is adjusted to the cost of investment rather than crediting to P&L account. Similarly, sir, subsidiary company profits have to be analyzed into pre-post. All by the time you are acquiring the subsidiary, whatever the profits are there in the subsidiary, they are all pre-acquisition profits. They are all capital profits. After you acquiring subsidiary, whatever the profits earned by the subsidiary, they are all post-acquisition profits, revenue profits. So that's why in order to segregate pre-post, I require what? Date of acquisition. That we decided in step number 1. That's why step number 1 is important. Date of acquisition, on which date you are acquiring, till that date whatever the profits are there, they are all profits. After that whatever the profits are there, they are post. So to determine the subsidiary company profits into pre and post, I need date of acquisition. And here the profits will be apportioned based on time. Assumption, sir, assumption. Time basis we will take. Okay, say this. For apportionment of profits between pre and post acquisition periods, we follow time basis, assuming profits are accruing evenly over time. So here as an assumption that profits are evenly same over the years. That's why we follow time basis to allocate the profits between pre and post. Okay, now the interesting point is, when you are analyzing the subsidiary company reserves into pre and post, there are three important adjustments which will play a crucial role. When you are analyzing the subsidiary company profits into pre and post, there are three adjustments. First adjustment is revaluation of assets of subsidiary company. Revaluation of assets of subsidiary company. First adjustment. Second adjustment, sir, dividend given by subsidiary company. Dividend given by subsidiary company. Third adjustment, sir, intra-group transactions between parent and subsidiary. And also bonus shares given by the subsidiary company. So while analyzing the reserves and surplus of the subsidiary company, we need to consider the effect of the following items in particular. What are those? Revaluation of assets of subsidiary company, dividends given by the subsidiary company, intra-group transactions between the parent and subsidiary. Tell me what are the important adjustments? Three important adjustments. First one, revaluation of assets of subsidiary. Revaluation of assets of subsidiary company. Second one, dividend given by subsidiary. Third, intra-group transactions between parent and subsidiary. These three are the highlights of this chapter. Each can be asked as a separate question. And in the big question, generally you see, either you will find revaluation of assets adjustment or dividend adjustments or intra-company, intra-group transactions between parent and subsidiary. These are the adjustments usually you find in big question sums. I will show you. If you want, after discussion, you go and check the previous exam question papers. Okay. So I will explain about these revaluation of assets or dividend given by subsidiary, intra-group transactions also. So tell me what we are discussing. Consolidation procedure. Which consolidation? Balance sheet or P&L? Balance sheet. Tell me the first step. Date of acquisition. Why date of acquisition is necessary? To analyze the profits of subsidiary into pre-post. Okay. What is step number 2? Shareholding pattern. On which date? On the date of consolidation. Why that is necessary? Next step, apportionment of profits. What is step number 3? Analyze the subsidiary company profits. Take each reserve of subsidiary company, divide into pre-post. All pre-acquisition profits, capital profits. All post-acquisition profits, revenue profits. And then, when you are analyzing the reserves and surplus of subsidiary company, you need to consider the revaluation of assets of subsidiary company, dividend given by subsidiary company, intra-group transactions. Next, see step number 4, sir. I will come back to step number 3. Those important adjustments I will explain. Sir, once you analyze the subsidiary company profits into pre-post, then what you need to do is, this subsidiary company profits is apportioned between the shareholders of subsidiary company. Who are the shareholders of subsidiary company? Parent and minority interest. So therefore, see this. Apportion the profits analyzed in step number 3 among the shareholders and minority interest, that means among the parent and minority interest. Here wrongly, among parent and minority interest. Okay, whatever the profits you divided, you need to divide, apportion, analyzed, you need to apportion between the parent and minority interest in step number 2. That's why step number 2 we decided the shareholding pattern. Now look at how apportionment is done. First, pre-acquisition profits. I told you all pre-acquisition profits are capital profits. Next, post-acquisition profit. Post-acquisition profit can be revenue reserve or can be revenue profit. Pre-acquisition profits are all capital profits. Post-acquisition profits either revenue reserve or revenue profit. Simple, sir. If you are analyzing the P&L account of the subsidiary company, that is called revenue profit. If you are analyzing other reserves of subsidiary company, they are called revenue reserves. Suppose you are analyzing the general reserve of subsidiary company, that is called revenue reserve. If you are analyzing the P&L account of the subsidiary company, that is called revenue profit. Okay, say one by one reserve. See, general reserve already you divided na into pre-post. So take each reserve, you already done in step number 3. In this general reserve, how much is the pre-acquisition, how much is the post-acquisition. In other reserves, how much is pre, how much is post. In P&L account, how much is pre, how much is post. Okay, actually when it comes to P&L, sir, amount should come here, revenue profit, because P&L account is revenue profit. Okay, understand. General reserve obviously pre-acquisition, post-acquisition, revenue reserve, correct only. Any other reserve also that. In this reserve, how much is pre, how much is post. In P&L account, how much is pre, how much is post. Now make a total. Then you divide this reserves and surplus which are apportioned as pre and post between the parent and minority interest. And in which ratio already we decided in step number 2. Already we decided in step number 2. How much is parent? 80%. How much is minority interest? 20%. For example. So this profits which is apportioned between the subsidiary company profits which are analyzed as pre and post, so will be divided to parent, minority interest. See this, parent, this is the parent share, this is the minority interest share. Now I will tell you the most important point, listen to me carefully. Sir, parent company share in the pre-acquisition profits, parent company share in the pre-acquisition profits of subsidiary, this amount is adjusted to cost of control, cost of investment in step number 6. While determining the goodwill or capital reserve, what we are doing? Cost of investment is compared with the share of net assets, which are represented by share capital plus reserves and surplus. On the date of acquisition, whatever the reserves and surplus are there in the subsidiary, they are basically what? Pre-acquisition. By the time you are acquiring the subsidiary, whatever the reserves are there, they are all what? Pre. In that pre-acquisition profit, as a parent company, what is your share? That will be adjusted to the cost of investment. So parent company share in the pre-acquisition profits adjusted to cost of investment. Cost of investment is adjusted with the parent company share in the net assets of subsidiary. The difference is goodwill or capital reserve. And parent company share in the post acquisition profits of subsidiary. See this, these are post acquisition profits. Understand, parent company share in the post acquisition profits, what we need to do is we need to add them to the parent company reserves in step number 8. Step number 8, when you are preparing the consolidated reserves of the balance sheet, the parent company share in the post acquisition profits of subsidiary company will be added to the consolidated reserves. Tell me, hello, what is step number 3? Analysis of the subsidiary company reserves. Correct? How you are going to analyze? Pre, post. Pre-acquisition profits are always capital. Post-acquisition or revenue profit or revenue reserve, or revenue reserve, revenue profit. Right? Once you analyzed, then you need to apportion. Apportion between whom? Shareholders of subsidiary. Who are shareholders? Parent, minority interest. Now, parent company share in the pre-acquisition profits of subsidiary adjusted to cost of investment. At the date of acquisition, we are finding goodwill or capital reserve na? Here, there. Parent company share in the post-acquisition profits of subsidiary will be added to the consolidated reserves in step number 8. We are doing step number 8. See this step number 8. See here. Step number 8. Reserves for consolidated balance sheet. In this step, you see here. See this. See point, everybody see. Add parent company share of post-acquisition reserves and profits of subsidiary. Step number 4. I have given a reference also. Parent company share of post-acquisition reserves and profits of subsidiary company will be added to the reserves of consolidated balance sheet in step number 8. Sir, why? Why they will be added? Pre-acquisition profits or capital profits. Therefore, they will be adjusted to the cost of investment. So therefore, they are not to be incorporated separately. But after you are acquiring the subsidiary, whatever the profits are there in the subsidiary, they are post-acquisition profits, right? Because of them, the net assets of the subsidiary increases. Therefore, the corresponding increase must reflect in the consolidated balance sheet. Therefore, understand, in the subsidiary company, by the time you are acquiring the subsidiary, whatever the profits are there, they are all pre-acquisition profits. They will be adjusted to the cost of investment. And the difference is goodwill or capital reserve we are showing. That means parent company investment, subsidiary company share capital plus reserves and surplus. We adjusted. The difference is goodwill or capital reserve we are showing. That means at the time you are acquiring the subsidiary, whatever the reserves and surplus are there in the subsidiary, they are already adjusted in the form of goodwill or capital reserve. Now, once you acquire the subsidiary, whatever the profits, whatever the reserves increases in the subsidiary, they will be added to the consolidated reserves. That means to the extent of the increase, the post-acquisition profits. In that post-acquisition profits, as a parent company, what is your share? That will be added to the consolidated reserves. You understand the logic? All pre-acquisition are adjusted. Post-acquisition will be added to the consolidated reserves. Okay. Sir, okay. Parent company, okay, share. What about minority interest? Minority interest share. Sir, minority interest share is added only to minority interest. Whether it is pre-na, post-na, doesn't matter. Entire minority interest share will be added to the minority interest in step number 5. In step number 5. See here. This one, entire minority interest. So, minority, step number 5 you see. I told you what is minority interest. Minority interest is nothing but minority shareholders' share in the net assets of the subsidiary company. Why we recognize minority interest? Because parent company is consolidating 100%. Even though we don't have 100%. Therefore, the share which is held by the minority shareholders, we need to recognize. So, how to calculate minority interest? Simple, net assets into minority percentage. So, net assets can be ascertained in 2 ways, either assets minus liabilities or share capital plus reserves and surplus. Here, reserves and surplus already divided into pre-post. So, in the pre and post acquisition profits, what is the share of the minority interest? So, you add to minority shareholders. See this. That's why here you see capital profits from step number 4. Capital profits means pre-acquisition profits. Minority interest share. Revenue reserve means post-acquisition profits. Minority shareholders share in step number 4. Revenue profit means pre-acquisition profits. Sorry, post-acquisition profits. Minority shareholders share. So will be added. Okay. So the most important steps is once you analyze the subsidiary company profits into pre and post, then you need to apportion these profits between parent and minority shareholders. Because the character of the profits of the subsidiary company is changing the accounting treatment. That's why we need to analyze. Understand that logic, you should not forget. Why we need to analyze the subsidiary company profits into pre and post? Because by the time you are acquiring subsidiary, whatever the profits are there in the subsidiary, they are all your capital profits. You don't have any investment, but you are getting the rights on those profits. They are your capital profits. Capital profits generally will not be credited to P&L account. That's why, see, in case of parent company, whatever the share they are getting from the pre-acquisition profits, what we are doing is, we are adjusting to the cost of investment. In cost of control step number 6, first we will take cost of investment. This cost of investment will be deducted with the value of investment, that is parent share of subsidiary net assets. When you are deciding the net assets, you are taking share capital and at the same time pre-acquisition profits. On the date, I told you, cost of control will be decided on which date? Date of acquisition. Date of acquisition. It's a one-time calculation, I told you. So date of acquisition means on the date of acquisition in the subsidiary, whatever the profits are there, which profits they are? Pre-acquisition profits. That way, see, share capital plus pre-acquisition profits. In this, what is the parent company share? We are comparing with the cost of investment. Any difference is there, that will be adjusted to goodwill or capital. So therefore, here what we need to learn is, parent company share in the pre-acquisition profits of subsidiary is adjusted in step number 6. Parent company share in the post-acquisition profits will be added to step number 8. Minority shareholders share will be considered in step number 5, minority interest. That's it. So this is step number 4. Okay. So when you are doing the consolidation, first date of acquisition, second shareholding pattern, third analyze the subsidiary company reserves and surplus into pre-post. Once you analyze, apportion between parent and minority interest. Now parent company share in the pre-acquisition profits adjusted to cost of investment in step number 6. Parent company share in the post-acquisition profits added to the consolidated reserves in step number 8. Minority shareholders share minority interest, step number 5. Okay. Okay. Now, sir, I told you, when you are analyzing the subsidiary company reserves and surplus, how many important adjustments are there? 3. Now I am going to talk about all these 3 important adjustments. Kindly concentrate. This is very, very important. Very, very important. So can you tell me what is the first adjustment? Revaluation of assets of subsidiary company. Revaluation of assets of subsidiary company. Sir, generally, sir, when parent company acquiring subsidiary company, what parent company will do is, they may revalue some of the assets of subsidiary company. They may revalue some of the assets of subsidiary company. Why they will revalue? Because parent company point of view, those assets are not properly valued. Happens, na? When suppose you are subsidiary company, I am parent company, I want to take over your company, I will look at your balance sheet and I feel some of the assets are not properly valued. So therefore, I will do revaluation. So generally revaluation will happen when? On the date of acquisition. So therefore, revaluation happens on the date of acquisition. Now revaluation can be, there are 2 possibilities. Revaluation of assets. As far as the revaluation of assets is concerned, there are 2 possibilities. Can you tell me what are the 2 possibilities? Either upward revaluation or downward revaluation. Either upward or downward. Upward means increase the asset value. Downward means decrease the asset value. When you increase the asset value, the increase generally transferred to revaluation reserve. But in consolidation, when parent company increases the asset value of subsidiary company on the date of acquisition, that increase is transferred to pre-acquisition profits, that is treated as capital profit. That is pre-acquisition profit, because you are doing exactly on the date of acquisition. For the purpose of this acquisition only, you are doing the revaluation. Therefore, whatever the profits are there, whatever the increase in the asset value, that will be treated as pre-acquisition profit, that is capital profit. So therefore, when you are analyzing the subsidiary company reserves and surplus, this revaluation profit will be considered as pre-acquisition profit, and you need to apportion that in step number 4 also. You need to analyze in step number 3, and also step number 4 you need to apportion. So whenever there is a upward revaluation, right, what we need to do? The increase in asset value is treated as pre-acquisition profits, correct? Pre-acquisition profits. That means it is which profit? Capital profit. Capital profit, not revenue profit. Okay. Sir, downward revaluation may also happen, sir. Parent company decreased the asset value of subsidiary company. Possible. Maybe in the subsidiary company any asset is overvalued. Now parent company decreased the asset value of subsidiary company. Downward revaluation. If there is a downward revaluation, same treatment. The decrease in asset. The decrease in asset is treated as pre-acquisition losses. Pre-acquisition losses, and it will be treated as what? Capital losses. Sir, whenever I said profits, opposite will also be there. So very simple, sir. When parent company is acquiring subsidiary company, sometimes subsidiary company assets are revalued. Here revaluation can be upward, downward. If there is an upward revaluation, the increase is treated as pre-acquisition profit, transferred to capital profit. If there is a downward revaluation, the decrease is treated as capital loss, pre-acquisition loss. Now tell me, because of this, is there any other consequence? Because of this, is there any consequence? Is there any effect on the profits of subsidiary company? Yes. Yes. What is that? See, if you do the upward revaluation, sir, definitely in future additional depreciation will come. That will reduce the post-acquisition profits of subsidiary company. Sir, if you increase the asset value, to that extent, your depreciation will be more. Because of that, my post-acquisition profits will be reduced. My means subsidiary company. So that also you need to consider. Because entire subsidiary company profits we are analyzing into pre-post. Because of the revaluation, whatever the profits, they are pre-acquisition capital profits. Now, because of this increase and decrease in the asset value, what happens? Either additional depreciation may come, or you may return off the excess depreciation. For example, if asset value decreased, then you provide less depreciation. Already in the books, you might provide depreciation on the original value. Therefore, the excess depreciation must be returned back. If you provide additional depreciation, your post-acquisition profits will be decreased. If you are writing back the depreciation back, your post-acquisition profits will increase. So that will also need to be considered. So please understand. So if there is an upward revaluation, sir, see this, additional depreciation will reduce the post acquisition profits of subsidiary company. So additional depreciation will reduce the post acquisition profits of subsidiary company. Sir, if there is a downward revaluation, excess depreciation will be added back. Hence, post acquisition profits, what happens to post acquisition profits? post acquisition profits will increase. Post acquisition profits will increase. So you understand this adjustment? You understand this adjustment? What is this adjustment? Revaluation of assets of which company? Subsidiary company. Who done the revaluation? Parent. Tell me, when you do the revaluation, how many possibilities? 2. What are those? Upward, downward. If there is upward, that increase will be treated as pre-acquisition profits. It is nothing but capital profit. Pre-acquisition. And because of the, if there is a downward, pre-acquisition losses, capital loss. Now, if there is an increase in the asset value, obviously what will increase? Additional depreciation. Because of that, your post-acquisition profits will decrease. You need to provide depreciation on the increased value. And if there is a downward revaluation, obviously asset value decreased, but you provided depreciation on the original cost. Therefore, whatever the excess depreciation you provide, what we need to do? Return back. If you add back the depreciation excess you provide, obviously your post-acquisition profits will increase. So this is the revaluation of assets topic. Sir, have you understood, sir? Very easy, sir. Very easy. Revaluation of assets. For example, sir, you see this. There is a property, plant, equipment, sir. This property, plant, equipment carrying value 1 lakh, sir. Now, parent company has increased this to 1,50,000. This is called revalued amount. So tell me how much increase? 50. So what is this 50,000? Can you tell me what is the entry we will write? Simple. Asset value increased na? PP account debtor to pre-acquisition profits. Simple. These are directly credited to which profits? Pre-acquisition profits. How much? 50,000, 50,000. That's it. So to the extent of 50,000, increase your pre-acquisition profits. And these pre-acquisition profits are nothing but which profits? Capital profits. And you know what to do. In step number 3, you analyze pre and post. Once you analyze pre-post, in step number 4, you need to apportion. That means this profit is also apportioned between the parent and minority interest. And parent company share in the pre-acquisition profits is adjusted to cost of investment. Parent company share in the post-acquisition profits will be added to consolidated reserves. Minority shareholders share in the pre and post-acquisition profits of subsidiary will be added to minority interest. So therefore, see, in step number 3, whatever I am analyzing, that is entirely affecting the accounting treatment. Because this pre and post, I am apportion between parent and subsidiary. And once I apportion between parent and minority interest, not subsidiary, parent company, minority interest, after that I am adjusting them. Pre-acquisition profits are adjusted to cost of investment, post-acquisition profits I am taking to consolidated reserves. So therefore, you have to be very careful. And now I increased the asset value 50,000, right? Suppose depreciation rate is 10%. Therefore, how much additional depreciation I need to provide? 5,000. This additional depreciation decreases my post-acquisition profits. That's it. My post-acquisition profits will be decreased by 5,000. Only remaining profits I need to analyze into pre-post. So that's it. This is one adjustment, sir. Sorry, you understand this adjustment? Hello? Yeah. Now, one more important adjustment. What I told, tell me. When you are analyzing the subsidiary company reserves and surplus, I told you one more important adjustment. What is it? Dividend. Very, very important. Listen to me carefully. Dividend given by subsidiary company. Sir, what is the treatment of dividend given by subsidiary company in consolidation? Simple. Listen to me carefully. When subsidiary company pays the dividend, sir, you need to see from which profits they have given dividend. If dividend is given from pre-acquisition profits, obviously the dividend received by the parent company is capital dividend, capital reserve, that will be adjusted to the cost of investment. If the dividend is given from post-acquisition profits, then parent company will credit the dividend to P&L account. That's it. Because post-acquisition profits are revenue profits. Pre-acquisition profits are capital profits. So from the capital profits, if any dividend given, that is also capital receipt. That is adjusted to cost of investment. So Simple. Dividend is given from which source? Dividend given from pre-acquisition profits, post-acquisition profits, you have to see. Sir, dividend given from pre-acquisition profits, sir. Simple, sir. Then dividend is adjusted to cost of investment. It is nothing but treated as recovery of my cost. Recovery of my cost. Therefore, as a parent company, what entry I will write? Bank account debit to investment account. I will directly adjust the dividend received from subsidiary company from pre-acquisition profits to my investment account. Suppose, for example, if dividend received from post-acquisition profit, this is credited to P&L account. Credited to P&L account. That means the entry is bank account debited to P&L account. Bank to P&L account. Guys, important. In the question, if they have given subsidiary company declared dividend, you see from which profit subsidiary company given dividend. If subsidiary company given dividend from pre-acquisition profits, then parent company share in that dividend. Parent company will receive dividend now because parent company invested in subsidiary. Therefore, whatever the dividend receivable by the parent company from the subsidiary, from the pre-acquisition profits, that dividend is treated as which dividend? Pre-acquisition profits, that dividend is adjusted to cost of investment. If dividend is received from post-acquisition profit, credited to P&L account. That's why you see step number 6, you see step number 6, cost of control. In this step, from the amount invested, I reduced what? Pre-acquisition dividend received from subsidiary company. I told you na, any dividend given by the subsidiary from pre-acquisition profits, then parent company adjusted to the cost of investment. That's why amount invested minus pre-acquisition dividend received. Sir, why? Already I told you, in the subsidiary company, whatever the profits are already there at the time of acquisition, the nature of those profits are capital profits. You don't have any investment till that point of time, but now you are getting rights on those profits also. Without having investment, if you get a right on any profits, they are what? Capital profit. They will be adjusted to cost of investment. That's why if you receive any dividend from subsidiary, from which profits? Pre-acquisition profits, adjusted to cost of investment. Adjusted to cost of investment. Sir, if dividend received from post-acquisition profits, P&L, normal dividend. If I purchase any company shares, after I purchasing those shares, if company declares a dividend for the future period, then these are my revenue profits. They will be credited to P&L account. Okay? So you understand this adjustment? Come on. Two important adjustments I explained. What is the first one? Revaluation of subsidiary company assets. Who will do the revaluation? Parent. When? On the date of acquisition. On the date of acquisition, any revaluation happened. How many possibilities? Two. Upward, downward. If there is an upward revaluation, pre-acquisition profit. Downward also pre-acquisition. Basically. Now, once upward, downward happened, because of that, is there any effect in future profits? Yes. If there is an upward revaluation, additional depreciation, which decreases my post-acquisition profits. If there is a downward revaluation, so whatever the excess depreciation I provided, I need to return back. So therefore, my post-acquisition profits will increase. Like, what is the second adjustment we done? Dividend given by subsidiary company. When subsidiary company pays the dividend, that dividend which is received by the parent, you need to see what? When dividend given by subsidiary company, which source the subsidiary company has given a dividend? Is it pre or post? If dividend is given from pre, adjusted to cost of investment. If dividend is given from post, credited to P&L account. This is another adjustment when you are analyzing the profits of subsidiary company. And one more important adjustment, sir. What is that? Intra-group transaction. See this. Intra-group transactions. This is also very interesting. Listen to me. Intra-group transactions. Sir, between the parent and subsidiary, any transactions might happen. Generally, purchase of goods, sale of goods may happen. Generally, those are called intra-group transactions. For example, everybody see A Limited, B Limited, two entities are there. A Limited is parent company. B Limited is subsidiary company. Subsidiary company. Suppose A Limited sold goods to B Limited. Cost 100 rupees. Profit 20. So sale value 120. Parent sold goods to subsidiary. Okay. Now you are preparing the consolidated balance sheet. That means A Limited, B Limited are both treated as one entity. Right? Now you tell me, when parent company sold goods to subsidiary, who has booked the profit? Parent, seller. Seller is A Limited, sir. Buyer, B Limited, sir. When I sold goods to anybody, I will recognize the profit now. That means how much profit recognized by parent company? 20. Profit recognized by parent company. But see, this stock, whatever sold by A to B, it remains unsold at the time of consolidation. Total stock not yet sold, 120. Now, AS 21 says, since the stock is not sold to outsiders, on this stock, what is unrealized profit? This is unrealized. Therefore, you need to eliminate. Eliminate. From the profits of which company? Parent. Because the profit is there in whose books? Parent books. So, in step number 8, from the parent company reserves, you deduct unrealized profit. Unrealized profit. If you want, you can check it. See this. Go to step number 8, sir. See this. Step number 8. See this. D point. Less reserves for. See this. Reserves for unrealized profit created. Reserves for which profits? Unrealized profit. Sir, first of all, you understand what is this unrealized profit? Unrealized means not yet realized, not yet received, or not yet realized. Why it is not realized? Because stock is not yet sold outside. It is still there with our subsidiary only, na? Sir, I am parent, sir. You are subsidiary. I sold goods to you. Stock is there with you only. Now I am doing consolidation. Now as a parent company, I see, I made sales to you. I recognize 20 rupees profit, but this profit is not yet realized because stock is there within the group only. Parent and subsidiary now one entity only. Consolidation means by treating parent and subsidiary as one entity. When you treat parent and subsidiary as one entity, whatever the stock is there with the subsidiary, it is my stock only, na? Stock is with me only. It is not yet sold, but I recognize the profit. Is it logically correct? Therefore, what I need to do? Eliminate. Eliminate this 20 rupees profit, which is not yet realized. From where I will eliminate? It is already there in the subsidiary company profits. That's why reduce from the subsidiary company profits. From the subsidiary company profits, you reduce this 20. Subsidiary company and parent company books, it is already there. So reduce from the parent company reserves. Parent company P&L account, this 20 rupees is there. So from the parent company P&L, you reduce this 20 rupees. Parent company post acquisition profits, revenue profits, P&L account is there, na? From that you reduce this 20 rupees. And also one more adjustment you need to do. What is that? Stock. Inventory value also be reduced by 20. Because this inventory, whatever parent sold to subsidiary, that inventory is valued at sale price, na? But it should be brought to cost. So therefore, inventory value is reduced by 20. Unrealized profit. Therefore, finally tell me what happens here. Two adjustments will be done. One is parent company post acquisition profits will be reduced. Second, inventory value will be reduced. Both are reduced by unrealized profit. Why? Profit not yet realized, but profit already recognized by parent. Therefore, from the parent company reserves you need to deduct. At the same time, from inventory value you need to deduct. Inventory value you need to deduct. Sir, is it logically understandable to you? Hello? Who sold goods to whom? Parent sold to subsidiary. Who booked the profit? Parent. In whose books the profit is there? Parent. Is this profit realized? So, at the time of consolidation, since parent and subsidiary is one entity, you can't recognize profit on sales made to you. Therefore, you eliminate this profit. Now, my question is, suppose you sold 120 sale value. Suppose this company, subsidiary company, managed to sold 60. That means what is the unsold portion? 60. So, tell me now how much URP, unrealized profit, will be eliminated? 10 rupees. Because total profit is how much? 20 for 120 sale value. Out of that, if 60 is sold, na sir, unsold is how much? 60. That means to the extent of inventory sold, profit realized. No need to eliminate. To the extent the stock not yet sold, in that 60, whatever the profit unrealized is there, 10, you need to eliminate. Therefore, from the parent company post-acquisition profits, you need to reduce 10. At the same time, inventory value decreased by 10. Hello? And this is called downstream transaction. Downstream transaction. Why it is called downstream transaction? Because parent company sold goods to subsidiary, sir. Parent sold to subsidiary, na sir. Parent obviously above, below that subsidiary. So goods are flowing from above to down. That's why it is called downstream transaction. So when downstream transaction happened, who booked the profit? Parent. So remove from the parent company books. At the same time, inventory value will be decreased. Now, upstream transaction next. Upstream transaction. Upstream transaction. Upstream transaction. What is this upstream transaction? When subsidiary sold goods to parent. Subsidiary sold goods to parent, sir. Suppose same example, sir. A limited, B limited, sir. Suppose B limited sold goods to A limited, sir. A limited is parent, B limited is subsidiary, sir. Sir, subsidiary company sold goods to parent, sir. Cost 100, profit 20, sale value 120. Subsidiary sold goods to parent. That means profit recognized by whom? Subsidiary. Stock is there with whom? Parent. Unsold stock. Suppose the total stock is not yet sold. Now you are doing consolidation. You are doing consolidation. Important, listen to me carefully. Sir, when subsidiary company sold goods to parent company, subsidiary company recognized the profit. Now in that sale, whatever the stock is there which remains unsold, now you are doing consolidation by treating A and B as one single entity. Now what is the accounting treatment? Simple. How much is the unrealized profit? 20. This unrealized profit is included in whose books? Subsidiary. But already subsidiary company profits we are analyzed into pre-post. We analyzed into pre-post, and in step number 4, we apportion between the parent and minority interest. Therefore, you need to reduce this unrealized profit from the parent company as well as minority interest. Because subsidiary company sold goods to parent means subsidiary company books already there is a profit. That was included in reserves and surplus. In step number 3, the reserves of subsidiary company we are divided into pre-post. And those reserves we apportion between the parent and minority interest in step number 4. Therefore, this unrealized profit is included in whose books? Parent, minority interest. So you eliminate from the parent as well as minority interest. So therefore, you need to see here, see this. In this 20, suppose in the subsidiary company, 80% is held by parent, 20% held by minority interest. So in this 20, 80% means 16 will be eliminated from parent company reserves. 4 is eliminated from minority interest. That's why you see here in this step, I will show you. See this. When you are preparing the consolidated balance sheet, step number 8 you come. See this. D point. What is the D point? Reserve for unrealized profit created. Same point. Sir, that means when parent company sold goods to subsidiary, profit is there in the parent company, 100% unrealized profit is eliminated from the parent company reserves. When subsidiary sold goods to parent company, in that unrealized profit, parent company share will be removed from the consolidated reserves. Sir, I am parent, sir. You are subsidiary. I sold goods to you, 120. 100 rupees cost, sold at 120. That means what is the profit? Entire 20 is unrealized. I need to remove. Correct? In consolidated balance sheet. Because this 20 is not a profit for the group. Stock is there with me only, in the group only. Okay? Entire 20 will be eliminated. Suppose subsidiary sold goods to parent. In subsidiary, I am having only 80%. Remaining 20, minority interest. Therefore, this profit is included in parent as well as minority interest. Therefore, I need to remove from the parent company minority interest. Respect to shares. So that's why, see here, reserve for unrealized profit I will deduct. And also you see minority interest. Step number 5, you see less stock reserve, minority share. If upstream, see this, upstream. You see step number 5, we deducted stock reserve. This is nothing but unrealized profit. In which case it will come? Upstream transaction. What is upstream transaction? Subsidiary sold goods to parent. When subsidiary sold goods to parent, in the profit is recognized by subsidiary, the profit should be shared between the parent and minority interest. Sir, here one interesting point, sir. Suppose at the time of analysis of profits of the subsidiary company itself, if I remove this profit, these unrealized profits from the subsidiary company profits, okay, then I am not required to do this adjustment because it is already eliminated. So only when the unrealized profit, the profit which is earned by the subsidiary on sale of goods to parent, if it is analyzed and apportioned in step number 3 and 4, then it has to be eliminated from the respective parent and minority interest. So do you appreciate this? So tell me, 2 things we have learned. What are the 2 things we learned? Upstream, downstream transaction. Tell me first upstream. Upstream what happens? Downstream. Downstream what happens? Parent sold to subsidiary. Who booked the profit? So if the stock is not yet sold, the entire unrealized profit we need to eliminate from parent company. In step number 8, consolidated. Step number 8, parent company reserves we need to eliminate. If subsidiary sold goods to parent, upstream. In upstream transaction, who booked the profit? Subsidiary. Subsidiary profits are already analyzed and apportioned between parent and minority interest. Therefore, this unrealized profit is there in parent company as well as minority. Remove from both. Minority interest, step number 5. Parent company shares, step number 8. Sir, you understood? This is the concept, sir. Now, sir, one more interesting point I will tell you, sir. Dividend, I forgot to tell one point, sir. Tell me, I told you, when subsidiary company gives the dividend, I told you we need to see the source. If the subsidiary company gives dividend from pre-acquisition profits, what we need to do? Adjusted to cost of investment. If subsidiary company give dividend from post-acquisition profits, what we need to do? P&L account. Sometimes in the question they will give like this. Subsidiary company given a dividend from pre-acquisition profits, but parent company created to P&L account. Sir, when subsidiary company gives dividend from pre-acquisition profits, generally parent company, whatever the dividend received, will be adjusted to cost of investment. But what they have done? Created to P&L. Now we need to rectify while solving the question. Therefore, how to rectify it? Already it is included in the parent company reserves. So in step number 8, you deduct wrongly created dividend. Hello? And in step number 6, cost of control step, so pre-acquisition dividend, we need to deduct from the cost of investment. So therefore, see here, interesting points. Dividend given by subsidiary from pre-acquisition profits. Pre-acquisition profits, dividend given. If dividend is given by subsidiary company from pre-acquisition profit, parent company, what they need to do? Bank account debit to investment account they will do, right? Correct? This dividend they need to adjust to the cost of investment. This is what we learned, correct? But sometimes what they will do is parent company will write a wrong entry. Wrong entry they will write. What is the entry they will write? Instead of adjusting to cost of investment, this entire dividend they created to P&L account. Now you need to pass a rectification entry. Rectification entry you need to pass. Can you tell me what will be the rectification entry? So, what is the rectification entry you need to do? You need to credit investment, but you credit P&L account. Therefore, first you need to add back. You need to deduct from the P&L account because it is already included in P&L account, this dividend. So, you need to reduce from P&L account and you need to reduce from investment. So, investment account will be created, P&L account will be debited. So, that's why you see step number 8. Step number 8, you see this one. Step number 8, reserves for consolidated balance sheet, you see. Dividend received from, see this, dividend received from which company? Subsidiary. Out of which profits? Pre-acquisition profits, but they transfer to investments. So from pre-acquisition profits, if dividend is received, it should be adjusted to investment account. But they have created to P&L. That's why we did deducted now. Deducted. And you go to step number 6, sir. Step number 6, you see. Pre-acquisition dividend we reduced it from amount invested. Why pre-acquisition dividend is reduced? Because pre-acquisition dividend is what? Capital profit. It is adjusted to cost of investment. So you understand this treatment? Sir, tell me, sir. Dividend given by subsidiary from pre-acquisition profits. As a parent company, you need to adjust to cost of investment. In step number 6, you need to reduce from amount of investment. Correct? But what you have done? I created to P&L account wrongly. Now I need to rectify the mistake. How to rectify? In the P&L account, reduce it. In step number 8. And in step number 6, you need to deduct from cost of investment. So this is 3 important adjustments while analyzing the profits of subsidiary company. So 3 important adjustments explained, sir. What is the first important adjustment? Revaluation of assets of subsidiary company. What is the second important adjustment? Dividend given by subsidiary company. What is the third important adjustment? Intragroup transaction. 2 transactions I explained. One is upstream, another one is downstream. Upstream means parent sold goods to subsidiary. That means profit, whatever unrealized is there in the parent company, we need to eliminate from step number 8. Entire profits, 100% profit. When subsidiary sold goods to parent, it's a upstream transaction. In this upstream transaction, the subsidiary company profits will be eliminated from the parent as well as minority interest. Because in step number 3, the subsidiary company profits are apportioned between the apportioned and analyzed and apportioned between parent and minority interest, right? So therefore we need to reduce from both the parties in step number 8 as well as step number 5. Okay, so see this. So first step, so come on, help me. Consolidation of balance sheet. What's step number 1? What is the date of first step? Date of acquisition. Why date of acquisition? To divide the subsidiary company profits into pre-post. What is step number 2? Shareholding pattern on the date of consolidation. Why this step is required? Whatever the profits of subsidiary analyzed, sir, we need to apportion between parent and minority interest. For that we need to know how much percentage they had. So step number 2. Step number 3. Analysis of reserves of subsidiary company. Subsidiary company reserves are analyzed into 2. Pre-post. All pre-acquisition capital profits. All post-acquisition revenue profits. And when you are analyzing the subsidiary company reserves and surplus, 3 important adjustments. What are those? Revaluation of assets. If revaluation of assets happen, upward or downward, it's a pre-acquisition profit or loss. And if there's an upward revaluation, additional depreciation affecting my post-acquisition profits. If it's a downward revaluation, excess depreciation will be written back, added back. Therefore, my post-acquisition profits will increase. Next, dividend given by subsidiary. Any dividend given by subsidiary company? Which source they have given? Pre or post? Pre. Cost of investment will be adjusted. Post. So, credited to P&L account. Sometimes parent company wrongly credited to P&L instead of adjusting to cost of investment. Rectify it. How to rectify? Reduce from the parent company reserves, and in step number 6, From the cost of investment, you deduct the pre-acquisition dividend. Right? Next, what is the third adjustment? Intragroup transactions. Upstream, downstream. Upstream, parent sold goods to subsidiary. Unrealized profit will be reduced from the parent company in step number 8. Subsidiary sold goods to parent. Unrealized profit will be apportioned between parent and minority interest. In step number 5, minority interest. In step number 8, parent company. Consolidated reserves. Sir, you understood? Next. Step number 4, we know. Step number 5, we discussed. In step number 5, can you tell me what is the most important thing? Upstream. Why minority interest is deducted in respect of stock reserve only in case of upstream transaction? Why in case of downstream transaction it is not eliminated? Because in downstream transaction, who sold goods to whom? Parent sold goods to subsidiary. When parent sold to subsidiary, profit is there in whose books? Therefore, how minority interest will be affected? Hello? Next, cost of control. Tell me how to calculate cost of control. Cost of investment. And to this amount investment, what we need to adjust? Pre-acquisition dividend. Why we need to deduct pre-acquisition dividend? Because it's a recovery of cost, capital profit. And we need to compare with the net assets. Parent company share in the net assets on the date of acquisition. The difference is either goodwill or capitalism. Okay. And this step also, step number 7, intercompany transactions. I told you this upstream, downstream transactions, sir. So in downstream, who sold goods to whom, sir? Parent sold to subsidiary. So unrealized profit eliminated from the asset, 100%. From the inventory, whatever the unrealized profit is there, we need to eliminate. And also, this unrealized profit is adjustment against parent company reserves, 100%. Minority interest, nil. Because here goods sold by parent to subsidiary. So entire unrealized profit is there in parent company books. Therefore, we need to eliminate 100% from parent company reserves. And see, if it is an upstream, upstream means subsidiary company sold goods to parent. From the inventory, total profit will be eliminated, unrealized profit. Always inventory will be brought to cost. Whoever sold goods to whom? Because you are preparing consolidated financial statements from group point of view. Whether parent sold goods to subsidiary or subsidiary goes to parent, doesn't matter in respect of stock. It is the group asset, right? Therefore, in that inventory, whatever the profit is there, you need to eliminate. That's why 100% profit eliminated, whether it is downstream or upstream. But when it comes to adjustment against reserves, in case of upstream, see this. To the extent of parent share in subsidiary in step number 7. Step number 7 or 8? I think step number 8. We are adjusting the parent company reserves in step number 8. So make it step number 8. Minority interest, step number 5. Sir, what is this step 8? Step 5 you understood? What is this step 8? Tell me. In consolidated reserves, basically first we start with parent company reserves. To that parent company reserves, we will adjust. This why we will adjust? Tell me. In this case, upstream transaction, why parent company reserves are adjusted? In case of upstream transaction, why parent company reserves are adjusted? Because in upstream, who sold goods to whom? Always remember, whenever upstream or downstream, forget, simple logic. Who sold the goods? You see first, who sold the goods? Subsidiary. Seller will recognize the profit. Correct? If profit is there in seller books, that profit already you analyzed in step number 3 into pre-post, and then you apportion between minority interest and parent, right? But the profit is now which profit? Unrealized profit. So it has to be eliminated. Unrealized profit has to be eliminated. From where it will be eliminated? In whose our books it is already included, in whose our accounts already it is included, eliminate. This profit, unrealized profit, already we apportion between parent and minority interest. So therefore deduct from both of them. That's it. That's why step number 8, step number 5. But in downstream, who sold the goods? Parent. That means profit is in whose books? Remove from parent, 100%. Sir, when only subsidiary company sold goods, sir, Because in the subsidiary company, parent and minority shareholders are the owners. Whatever the profits of the subsidiary company, they will share, na sir. So therefore, in the profits of subsidiary, which is already shared between the parent and minority interest, there is an unrealized profit. Why unrealized profit? Because goods are sold by, 1 minute. Goods are sold by whom? Subsidiary to parent. The profit we will eliminate from both of them. Okay. And also, sir, any intercompany owings or debts. Any intercompany owings or debts. Parent company sold goods to subsidiary. Subsidiary sold goods to parent. Because of the trade receivables, trade payables. Any loan given by parent to subsidiary. So these are mutual debts and owings are there. These mutual debts and owings also we will eliminate when we prepare the consolidated balance sheet. Common sense. Why we will adjust? Because parent and subsidiary is treated as one entity only, na? So I can't due amount to myself. So therefore, like in amalgamation we have done. Trade receivables, trade payables, bills receivable, bills payable, loan given, loan received. We adjusted, na? Similarly, parent company at the time of preparation of consolidated balance sheet, whatever the mutual debts are there, they will be eliminated. Like see this. Debtors, creditors, loans given, loans taken, interest receivable, interest payable, fees receivable, fees payable, dividend receivable, dividend payable. The adjustment involves reduction of the amount from the aggregate of both receivable and payable. Aggregate of both receivable and payable. For example, see this. One simple example I will give. A Limited, B Limited. Two companies are there. Loan 10 lakhs. B Limited loan 5 lakhs. Okay. Now, parent point of view, this is asset, loan given. Subsidiary point of view, this is liability, loan taken. Now, you are preparing consolidated balance sheet. Okay. What we will do? Suppose you are preparing consolidated balance sheet. Parent company loan, asset, how much? 10 lakhs, right? In this 10 lakhs, 5 lakhs is given to B Limited only. Therefore, I will deduct 5 lakhs. So, only remaining 5 lakhs will be shown in the consolidated balance sheet. Because in this 10 lakhs, sir, how much is given to B, sir? 5. Now, when it comes to liabilities, so loan, B Limited loan is there, na sir, 5 lakhs. We will take how much? Nil. Why? 5 lakhs minus 5 lakhs. Why we deducted 5 lakhs? Because this loan and this asset, A Limited loan given, B Limited loan taken, both will be adjusted. Why they will be adjusted? Because A and B are one entity now. A given to loan B. A and B one entity. That means loan given, loan taken, same party, na? So therefore, this intra-group items will be irrelevant. Eliminate. Similarly, suppose trade receivables, trade payables. Parent company books to trade receivables, certain portion is B Limited only. B Limited point of view trade payables, A Limited point of view trade receivables, both will be adjusted. Common debts, sir, common debts. Because A Limited, P Limited now treated as one single entity. That's why. Okay. So this is step number 7, sir. And what is step number 8, sir? Reserves for consolidated balance sheets. Sir, important, sir. When you are preparing the reserves for consolidated balance sheet, first always start with the parent company reserves. Reserves as appearing in the parent's balance sheet. Parent company reserves you take. And tell me till now what adjustments I have we have discussed relating to this. I will recollect one by one. First, parent company share in the post acquisition profits of subsidiary will be added. Correct? See this. Parent company share in the post acquisition reserves and surplus. Step 4, sorry, apportionment. One adjustment. Second adjustment, parent sold goods to subsidiary. In that, unrealized profit will be eliminated. See this. Reserves for unrealized profit eliminated. One more adjustment, dividend adjustment. Dividend received from subsidiary from pre-acquisition profits but wrongly included in P&L. Therefore, now we need to deducted from the P&L account. So these three already we have discussed. Tell me, this is important. What adjustments will come in consolidated reserves? First, always you start with what? Parent company reserves. Now to this parent company reserves, three adjustments. Tell me, first adjustment, parent company share in the post acquisition profits of subsidiary. First. Second, any unrealized profit in respect of transactions between parent and subsidiary, eliminate. Next, any dividend received from subsidiary from pre-acquisition profits wrongly credited to P&L, now deduct. These three. Apart from that, capital reserve will also come. What is this capital reserve? In step number 6, cost of control step, either goodwill or capital reserve come, sir. If there is a capital reserve, that you will take it. Now, whatever the reserves came, this is the reserves for consolidated balance sheet. These are the reserves for consolidated balance sheet. So that's it, Nana. This is the consolidation procedure. So one last time consolidation procedure we will discuss. First, tell me, what is the first step? Date of acquisition. On which date parent acquired subsidiary? This date is relevant for analyzing the subsidiary company profits into pre-post. Step number 2. Shareholding pattern on the date of consolidation. On the date of consolidation, in the subsidiary company, parent company is having how much? Minority shareholders is having how much? Decide, determine. What is step number 3? Analyzing the subsidiary company reserves into pre-post. Pre-acquisition profits, capital profits. Post-acquisition profits, revenue profits. While analyzing, 3 important adjustments. What are those? Revaluation of assets, dividend given by subsidiary, intragroup transactions, downstream, upstream. Everybody, what is step number 4? Apportionment of subsidiary company analyzed profits. How you do apportionment? Pre-acquisition profits, capital profits, post-acquisition profits, revenue reserve. Apportion between parent and minority interest. And step number 5, minority interest. How to calculate minority interest? Minority interest is calculated. In the subsidiary company, share capital, what is the share of minority shareholders? In reserves, pre-acquisition, post-acquisition reserves, what is the share? You need to deduct one thing. What is that? Stock reserve in respect of upstream transaction. Upstream. When subsidiary sold goods to parent, so unrealized profit of the subsidiary is apportioned between the parent and minority interest. So from minority interest you need to deduct. Because you already done apportionment and analysis. You apportion between the parent and minority interest. What is step number 6? Cost of control. How to calculate cost of control? Amount invested minus pre-acquisition dividend. Then you will get adjusted investment. Compare with the share in the net assets of subsidiary company. And this is calculated on which date? Date of acquisition. Therefore, share capital plus pre-acquisition profits. In that, what is your share? Compare. The difference is goodwill or capital reserve. And what is step number 7? Intercompany transactions. I told you, any intercompany owings are there, eliminate. And also, any transactions happen between parent and subsidiary. Upstream, downstream, adjust. And what is step number 8? Reserves for consolidated balance sheet. When you are preparing consolidated reserves, first you need to start with what? Parent company reserves. 3 important adjustments I told you. So, parent company share in the post-acquisition profits of subsidiary, unrealized profits, and any dividend given by subsidiary from pre-acquisition profits wrongly credited to P&L, adjust. And last step, preparation of consolidated balance sheet. And in preparation of consolidated balance sheet, already I told you, share capital, always which company share capital we need to take? Parent. Reserves, step number 8. Minority interest, step number 5. And any liabilities, both the company's liabilities minus intercompany transaction. Intercompany owings eliminate. Fixed assets, same. Both the company's assets will be added, and any unrealized profit, any revaluation adjust, and also any goodwill comes in step number 6, take it. Investments, parent company investment in subsidiary shares, will you consider it? No. Only these are outside investments we will consider. And last one, current assets, loans and advances. Simple. Add parent, subsidiary. Any intercompany dues, eliminate. That's it. Important adjustments also I told you. Revaluation of assets, dividend, and eliminate intragroup transactions. Bonus shares I will cover it. Wait. So except bonus shares, all things we have discussed. So tell me, have you understood the entire consolidation procedure? Are you comfortable?